You ever sit back and look at the stock market and wonder, am I on the right side of this? That's exactly where I found myself recently. For months, the headlines have been full of optimism, growth projections, record-breaking earnings, and endless bullish commentary. Everyone seems convinced the market is a one-way street, and yet when you dig a little deeper, things don't always line up. That's when I realized it might be time to make a bold move, a calculated bet against the stock market. And no, this isn't about following a trend or jumping on some hype-driven strategy. This is about analyzing the fundamentals, investment, studying the numbers, and making a move that aligns with logic, data, and long-term planning. Let me take you through what brought me here. First, there's the undeniable reality of valuations. Stocks aren't just high, they're sky high. Price to earnings ratios in many sectors are well above historical averages, and there's a growing disconnect between stock prices and actual economic growth. It's like watching a balloon inflate further and further, knowing that physics eventually wins. Investors often get caught up in the excitement, the momentum, and the fear of missing out. But history has shown that when things get this frothy, corrections aren't just likely, they're inevitable. Recognizing this pattern isn't pessimism, it's realism. It's the part of investing that separates speculation from strategy. Next, let's talk about risk. Every investment carries it. But betting against the market requires a special kind of awareness. This isn't a reckless gamble. It's calculated. You have to understand not just the potential reward, but the exposure, the timing, and the broader context. I spent weeks analyzing market cycles, reviewing economic reports, and testing scenarios to ensure that this move isn't impulsive. It's about making a decision rooted in discipline, not emotion. And discipline in the financial world is worth more than luck or guesswork. It's the difference between walking away with gains and watching opportunities slip through your fingers. Of course, execution matters. You can't just say, investment, I'm against the market and expect it to work out. There's a strategy behind it, the right instruments, and a clear plan for entry and exit. This includes understanding derivatives, hedging techniques, and diversification to ensure that the bet is balanced. The goal isn't to be contrarian for the sake of being contrarian. It's to create a position that protects capital, takes advantage of trends, investment, and leverages the opportunities that arise when others are blinded by optimism. Finally, there's the mindset. Making a bet against the market isn't just a financial decision, it's a mental one. It's about remaining calm when the market goes against you, staying rational when headlines scream panic, and sticking to a plan when everyone else is reacting emotionally. The lessons here go beyond any single trade. They teach patience, critical thinking, and the importance of being proactive rather than reactive. And while some may call it risky or unconventional, I see it as disciplined preparation, positioning for potential outcomes that the majority refuses to acknowledge. So today, I'm sharing my approach, my reasoning, and my strategy, not because I expect everyone to follow, but because understanding this perspective can change how you think about the market entirely. It's not about luck, it's about logic, investment, timing, and preparation. And if you're willing to pay attention and learn, you might see opportunities that others blindly overlook. This is my new bet against the stock market. And it's as much about mindset and strategy as it is about the numbers on the screen. When you start looking at the stock market closely, the first thing that hits you is the sheer magnitude of the numbers. Every day, there's a new record being broken, new highs being celebrated, and analysts projecting ever increasing growth. On the surface, it seems like there's no reason to worry. Why would you bet against something that's constantly climbing? But here's the thing, the market doesn't move in a straight line forever, and understanding the conditions at a macro level is critical before making any move. Timing isn't just about guessing the next day's price. It's about recognizing patterns, identifying overvaluation, and seeing the signs that the broader system is shifting. Right now, what I see is a market that is incredibly stretched. Stocks across multiple sectors are trading at valuations that investment historically have only appeared before corrections. Price to earnings ratios, price to sales ratios, and other key indicators are all signaling caution. Investment. And while it's tempting to dismiss these numbers because this time feels different, history has a way of repeating itself, especially when human psychology is involved. When investors get overly optimistic, they stop focusing on fundamentals and start riding momentum. That's when markets become fragile, and the slightest negative news can trigger a domino effect of selling. And recognizing these patterns is crucial because it allows you to make a proactive move rather than reacting when the correction has already begun. Economic signals also matter. Interest rates, inflation, corporate earnings, and consumer behavior all paint a picture of where the market is headed. Recently, certain indicators have suggested that growth might be slowing, even if earnings reports are still relatively strong. Slow growth combined with high valuations is a recipe for vulnerability. Investors may continue to push prices higher for a while, but the risk increases exponentially as the disconnect between price and underlying value grows. This isn't about pessimism, it's about observing reality. The market isn't just numbers on a screen. It's a reflection of collective human behavior reacting to economic conditions. Timing in this context is also about patience and discipline. It's tempting to think you need to jump in immediately when you notice a potential shift, but there's a difference between a calculated entry and an impulsive decision. I spent weeks analyzing charts, reviewing historical corrections, and comparing current conditions to past cycles. What stands out is that while the market may continue to climb in the short term, the underlying signals indicate that it's prudent to prepare for a potential downturn. Timing isn't about predicting the exact day the market will turn. It's about positioning yourself so that when the shift occurs, you're ready to act strategically. Another key factor in assessing market conditions is understanding the sectors most exposed to risk. Technology, consumer discretionary, and high growth stocks often lead the market during bullish cycles, but they're also the most vulnerable when sentiment shifts. By analyzing which sectors are overextended, which companies are showing signs of strain, and where valuations are becoming extreme, you gain insight into optimal timing for a move against the market. It's about stacking the odds in your favor, not trying to predict the unpredictable. Ultimately, this is about recognizing opportunity in the context of risk. The market is rarely a level playing field. There are times when conditions favor bullish moves and times when being cautious or even contrarian can yield significant advantages. Right now, the signals suggest caution, and that's why I've chosen to take a calculated position against the market. Understanding market conditions and timing isn't just the first step in a strategy. It's the foundation that determines whether every other decision you make will be informed, disciplined, and potentially profitable. Making a decision to bet against the stock market isn't something that happens on a whim. It's not about being contrarian for the sake of being different or reacting to a single headline. It's about a structured analysis of risk versus reward, understanding the underlying fundamentals and seeing patterns that others often overlook. The reasoning behind this particular move is rooted in a combination of valuation concerns, historical trends, economic signals, and psychological factors driving the market. When you combine all of these elements, the logic becomes clear. There's an opportunity to protect capital, leverage downside potential, and strategically position for a potential correction. First and foremost, the reasoning begins with valuations. Many stocks today are trading at levels that far exceed their historical norms. High price to earnings ratios, inflated price to sales multiples, and stretched profit margins indicate that expectations for future growth are extraordinarily high. Investors are essentially pricing in perfection. And while optimism can drive short-term gains, it also increases vulnerability. When reality fails to match expectations, the market tends to react sharply. In investment, betting against the market in this environment is not about pessimism. It's about recognizing that the current prices don't accurately reflect risk. It's about understanding that when expectations are too high, even a small disruption can trigger outsized consequences. Next, historical market patterns provide critical context. Markets operate in cycles, and while no two cycles are identical, patterns often repeat in recognizable ways. High valuations, low volatility complacency, and exuberant investor sentiment have historically preceded market pullbacks. By studying past corrections, it becomes evident that periods of excessive optimism tend to end with sharp, rapid declines. This isn't speculation. It's learning from patterns and applying logic to the current environment. Betting against the market is therefore grounded in the principle of aligning probability with preparation rather than gambling blindly. Economic signals also play a huge role in the reasoning behind this move. Slowing GDP growth, rising interest rates, inflationary pressures, and changing consumer behavior all signal caution. Even if stock prices continue to rise in the short term, underlying economic weaknesses increase the likelihood of a correction. Companies may struggle to meet earnings expectations, investors may begin to reassess risk, and sentiment can shift quickly. The reasoning behind betting against the market is that by analyzing these indicators carefully, you can anticipate a shift in momentum before it becomes obvious to the majority. It's about foresight rather than hindsight. Psychology and market behavior add another layer of reasoning. Investors are often driven by fear of missing out and herd mentality. When everyone believes the market can only go up, rational caution is often ignored. By taking a contrarian approach, you position yourself to capitalize on situations where the crowd's optimism is ungrounded in reality. This requires discipline and a willingness to go against the tide. But it's precisely this discipline that allows strategic moves to outperform emotional decisions. The reasoning here is simple. When the crowd is wrong, opportunities for informed investors emerge. Finally, Risk management and probability weigh heavily in the logic behind this decision. Betting against the market doesn't mean reckless exposure or hoping for the worst. It's about calculated positions, hedging where appropriate, and understanding the risk-reward profile. The rationale is to create a strategy where downside potential is mitigated, upside is defined, and the position aligns with a realistic assessment of market conditions. By combining valuation analysis, historical patterns, economic insight, and psychological understanding, the reasoning becomes clear this is a deliberate, disciplined, and informed strategy designed to navigate an uncertain environment intelligently. In essence, the reasoning behind this new bet against the stock market is grounded in logic, data, and a structured approach to risk. It's not about fear. It's about preparation. It's not about timing the market perfectly. It's about positioning in a way that accounts for both probability and potential outcomes. And when executed with discipline, this approach can protect capital, create opportunities, and ultimately serve as a blueprint for rational decision making in an environment that often rewards emotion over reason. Taking a position against the stock market is one thing in theory, but the real challenge comes in execution. You can recognize overvaluation, analyze economic indicators, and understand historical patterns, but if you don't have a clear, practical strategy, all that analysis is wasted. Execution is where strategy meets action. Investment. And it's what separates thoughtful investors from those who simply react emotionally. A successful bet against the market requires careful planning, the right instruments, risk management, and timing, all aligned with your broader financial goals. The first step in execution is deciding how to position yourself. There are multiple avenues available, each with its own risk and reward profile. Short selling individual stocks is one method, but it carries substantial risk because losses can be theoretically unlimited if the stock continues to rise. Options provide another approach, giving the ability to control exposure while limiting risk. Inverse ETFs are a third option, allowing you to profit from a decline in broad market indices without the need to short individual stocks. The choice of instrument depends on your risk tolerance, capital allocation, and market outlook. What's critical is selecting a method that aligns with your comfort level and your understanding of market mechanics. Once the instruments are selected, timing and entry points become paramount. Execution isn't about jumping in as soon as you feel cautious. It's about analyzing price action, market sentiment, and technical indicators to find optimal entry points. For example, even if valuations are high, shorting the market during a brief pullback or a period of low volatility can increase risk. Conversely, identifying periods of temporary strength followed by underlying weakness can present ideal opportunities. This is where technical analysis meets fundamental understanding, helping to refine execution and improve the probability of success. Risk management is another critical piece of execution. No strategy is foolproof, and markets can remain irrational longer than expected. Proper position, sizing, stop-loss orders, and hedging are all essential to protect capital, while still maintaining exposure to potential gains. The goal isn't to be reckless. It's to strategically manage exposure while positioning for potential downside. Hedging against unexpected market events or using multiple instruments to diversify your approach can reduce risk without compromising your overall thesis. Execution without risk management is like driving a high-performance car at top speed without brakes. It might feel exciting, but the consequences of a mistake are severe. Monitoring and adjustment are ongoing aspects of execution. The market doesn't remain static, and new economic data, corporate reports, or geopolitical events can impact your position. This means continuously evaluating your strategy, adjusting positions if necessary, and staying disciplined rather than emotional. Execution isn't just the initial action, it's a continuous process of observation, analysis, and tactical refinement. Being flexible while sticking to your core thesis is what separates thoughtful, strategic investors from reactive traders who let emotions dictate outcomes. Finally, communication and record keeping are often overlooked but critical components of execution. Tracking why you entered a position, what your expectations are, investment, and how you plan to exit ensures that every decision is deliberate. This practice not only enhances accountability, but also provides invaluable feedback for refining future strategies. Execution is not a single moment in time. It's a structured process that spans entry, management, adjustment, and reflection. In summary, execution is where strategy transforms into results. It requires selecting the right instruments, identifying optimal entry points, managing risk effectively, monitoring changes, and maintaining discipline. Betting against the market isn't just about recognizing opportunity. It's about implementing a well-thought-out plan that maximizes potential while controlling downside. Done correctly, execution turns analysis into tangible results, allowing you to capitalize on market inefficiencies with confidence and clarity. Without execution, even the best reasoning and analysis remain theoretical, but with execution, insight becomes action, and action becomes opportunity. When you step back from making a strategic move against the stock market, the most important part isn't just the trade itself. It's the lessons you take away from the process. Every investment, whether it succeeds or fails, offers insight into market behavior, human psychology, and your own decision making. Betting against the market is a unique learning opportunity because it forces you to think differently, act deliberately, and embrace principles that many investors overlook in their pursuit of short-term gains. The lessons from this process extend far beyond a single position. They shape how you approach investing, risk management, investment, and financial discipline in the long term. First, one of the most critical takeaways is the importance of patience. Markets don't move according to our personal schedules, and corrections or downturns often take longer to materialize than we expect. This isn't about waiting passively. It's about staying informed, monitoring conditions, investment, and maintaining conviction in your thesis without becoming anxious about daily fluctuations. Many investors fail because they act impulsively, selling too soon, or doubling down recklessly. Learning to be patient and disciplined allows you to avoid emotional decisions, stick to your plan, and capitalize when the market eventually aligns with your analysis. Patience is a lesson that transcends any single trade. It's a fundamental principle of sustainable investing. Another lesson is the value of preparation and research. Betting against the market successfully requires far more than instinct or speculation. It demands rigorous analysis, understanding historical patterns, evaluating economic indicators, and assessing sector-specific risks. Preparation is what turns potential opportunity into informed strategy. It's also what separates strategic investors from reactive traders. By investing time in research and analysis, you gain a mental framework that allows you to respond rationally, not emotionally, when the market behaves unpredictably. This takeaway emphasizes that knowledge isn't just power, it's protection. A risk management emerges as another vital lesson. Taking a contrarian position exposes you to potential volatility, and without proper safeguards, a seemingly smart bet can turn into a costly mistake. Position sizing, diversification, hedging, and stop-loss strategies are all practical tools that mitigate downside while preserving opportunity. The broader takeaway here is that investing isn't about avoiding risk entirely. It's about understanding, measuring, and managing it. Investment. By embracing risk management principles, you learn to balance ambition with caution, maximizing potential while minimizing exposure to catastrophic losses. A subtler yet equally important lesson is the role of emotional intelligence in investing. Markets are driven by human behavior, fear, greed, optimism, and panic. Recognizing your own emotional triggers, understanding the crowd's psychology, and maintaining rationality in the face of volatility are crucial skills. Taking a position against the market often challenges conventional thinking, and it's easy to feel isolated when the majority remains bullish. By cultivating emotional discipline, you learn to stay focused on facts and probabilities rather than getting swept up in hype or fear. Finally, the ultimate takeaway is that investing is as much about mindset as it is about strategy. Betting against the market teaches you to think independently, analyze objectively, and act decisively. It reinforces the importance of planning, patience, and reflection. Every trade, successful or not, becomes a learning experience that sharpens your judgment for future opportunities. This mindset doesn't just apply to one market or one trade, and it becomes a guiding principle for long-term financial decision-making, shaping how you approach opportunities, manage risk, and evaluate outcomes across every aspect of investing. In conclusion, the lessons and takeaways from taking a position against the stock market are invaluable. They teach patience, discipline, preparation, risk management, and emotional intelligence. They emphasize that investing is not a game of luck, but a practice of strategy, critical thinking, and long-term planning. By internalizing these lessons, you not only enhance your ability to navigate volatile markets, but also develop the mindset and skills that are essential for consistent, sustainable financial success. Betting against the market isn't just about a single trade. It's about becoming a smarter, more informed, and more disciplined investor for the long haul.